Module 2, Lesson 3, Fundamentals of Accounting. Lesson 3, the chart of accounts and types of accounts. Remember, what is a chart of accounts? A chart of accounts, COA, is a complete, organized list of all the account titles a company uses to record financial transactions. Think of it as the index or map of the accounting system. It helps you know where to record and find specific financial information. Purpose of a chart of accounts: categorizes all financial transactions for accurate reporting, ensures consistency in how financial activities are recorded, simplifies financial statement preparation, helps in budgeting, analysis, auditing, and tax filing, serves as a control mechanism to avoid miscoding. Components of a chart of accounts: accrual method. In the accrual basis of accounting, income is recorded when earned and expenses when incurred, not when cash is exchanged. This makes it important to classify accounts precisely for proper matching of revenues and expenses. Each account is assigned a unique account code to make posting and referencing easier. Assets are what the business owns or controls that provide future economic value. Think of assets as the resources that help a business run its operations and generate income. Assets are usually classified into two major categories: smalling. First, current assets. These are assets that are expected to be used up, sold, or converted into cash within the next 12 months. These are crucial for managing a business's day-to-day operations. Let's go over some key current asset accounts. 1,000, cash. This refers to the business's available money, whether it's in a bank account or physically on hand. This is the most liquid asset and often used for everyday transactions. 1010, petty cash. This is a small amount of cash kept on hand for minor, immediate expenses, like buying office supplies or paying for delivery fees. 1100, accounts receivable. These are amounts owed by customers who have bought goods or services on credit. If a client hasn't paid you yet but will in the near future, it's recorded here. 1110, allowance for doubtful accounts. This is a contra asset, meaning it's an asset account with a credit balance. It reflects the estimated portion of receivables that may never be collected. 1200, notes receivable, short term. These are formal written promises from customers to pay a specific amount within 1 year. Think of it like a customer signing a loan agreement with your business. 1300, inventory. This account includes the goods your business intends to sell or raw materials for production. If you run a bakery, this would include ingredients like flour, sugar, and finished cakes ready to sell. 1400, prepaid expenses. This includes payments made in advance for services you will receive in the future, like prepaid rent, insurance, or subscriptions. 1500, supplies. This account covers consumable items that are not yet used, such as office stationery or cleaning materials stocked in your supply cabinet. Next, non-current assets. Now let's move to non-current assets, which are assets that the business intends to keep for more than 1 year. These help in generating income over the long term. 1600, equipment. This includes tools, machines, and other equipment used in business operations, like a coffee machine in a cafe or a printer in an office. 1610, accumulated depreciation. This is another contra asset account. It tracks the total reduction in value of your equipment and fixed assets over time due to wear and tear. 1700, property, plant, and equipment, or PPE. This includes land, buildings, and other large fixed assets. These are major investments that help the business operate for years. 1800, long-term investments. These are financial assets or investments that the business doesn't plan to convert into cash within a year. It could include bonds, shares, or real estate held for long-term gain. 1900, intangible assets. These are non-physical assets that still hold value, such as patents, copyrights, trademarks, or goodwill from a strong brand reputation. We'll dive into the liabilities section, a crucial part of understanding what a business owes to others. These accounts typically begin with the numbers 2000 to 2899, and they help us keep track of debts, obligations, and upcoming payments. Liabilities are classified into two groups: categories. First, current liabilities. These are obligations that the business is expected to settle within the next 12 months. Current liabilities are important because they directly affect short-term cash flow and working capital. Let's walk through the most common current liability accounts. 2000 accounts payable. This is the amount the business owes to suppliers for goods or services bought on credit. For example, if you purchased baking ingredients for your cafe but haven't paid the supplier yet, that amount goes here. 2100 notes payable, short term. These are formal written agreements to pay a loan within a year. Let's say your business borrowed $100,000 from a bank to buy inventory, payable in 6 months. This would be recorded here. 2200 accrued expenses. These are expenses that have been incurred but not yet paid. Examples include electricity used in March but not billed until April. These are matched with the period when the cost was actually incurred. 2300 salaries payable. This tracks wages that employees have earned but haven't been paid yet. For instance, if your staff worked from March 25th to 31st, but payday is April 1st, the March salary falls under this account. 2400 unearned revenue. This might sound confusing, but it's when a business receives payment before delivering goods or services. For example, if a client pays for a cake order in advance, but you haven't made or delivered it yet, that's unearned revenue because you still owe the customer that cake. 2500 taxes payable. This covers all taxes the business owes to the government. It can include VAT, income tax, withholding tax on salaries, or even local business taxes that haven't been paid yet. These accounts help ensure the business is aware of what needs to be paid soon, essential for maintaining good financial health and avoiding penalties or broken trust with suppliers and employees. Next, non-current liabilities. Now let's move on to non-current liabilities. These are obligations that are not due within the next 12 months. They represent long-term debt or commitments that take more time to repay. Here are key accounts under this category. 2600 notes payable, long-term. These are formal loan agreements that stretch beyond 1 year. For example, a 3-year loan taken to buy commercial kitchen equipment falls here. 2700 loan payable. This is similar to long-term notes payable, but usually tied to formal financing from banks or lending institutions. If your business took a 5-year business loan, the balance, except the amount due within the year, would be recorded here. 2800 bonds payable. This account is common in larger companies. It tracks money raised from issuing bonds, essentially IOUs to investors that will be repaid with interest over time. We've already looked at assets and liabilities, which describe what the business owns and owes. Now let's turn our attention to the owner's interest in the business, how the business earns income, and where it spends money. Equity accounts. 239.99. Equity reflects the owner's claim on the business after liabilities are paid. It tells us who owns what and how much profit is kept in the company. Let's explore some common equity account codes. 3000 owner's capital. This account shows how much the owner has invested in the business. For example, if Maria starts a bakery and puts in 100,000 of her own money, we record that here. It's her initial contribution to start and run the business. 3100 owner's drawings. This account records any withdrawals made by the owner for personal use. Let's say Maria takes 5,000 out of the business to pay for personal expenses. That's recorded as a drawing. It's not an expense, but it reduces equity. 3200 retained earnings. This is the profit the business has earned and kept over time instead of paying it out. In corporations, this is crucial. It shows how much money is being reinvested into operations or used for future growth. 3300 share capital, used in corporations. This account reflects money raised by issuing shares. For example, if a startup sells shares to investors, the funds received are credited here as part of the company's capital. In short, equity shows how much the owners or shareholders have invested, withdrawn, and how much profit remains in the business. Revenue accounts, 4,000 to 4,999. Revenue is the money a business earns from its operations. These accounts track the different ways a company brings in income. 4,000. Sales revenue. This is income from selling goods, like products in a retail store or baked goods in a cafe. It's the bread and butter of businesses that sell physical items. 4,100. Service revenue. For businesses that offer services, like bookkeeping, consulting, or plumbing, this is where income is recorded. For example, if a freelance accountant charges a client 10,000 for monthly services, that's recorded here. 4,200. Interest income. This represents earnings from financial activities, like bank interest or income from loaning money. Not core to most businesses, but still important. 4,300. Other income. This is a catch-all category for any earnings not directly tied to the main business. Say you sell an old office printer and earn a few thousand pesos. That goes here. Revenue accounts help track how the business generates money, giving insight into performance and profitability. Expense accounts, 5,000 to 5,999. Now, let's talk about expenses, the costs of running the business. These accounts are where we record every peso spent to operate, grow, and maintain the company. 5,000. Rent expense. The cost of leasing a store, warehouse, or office space. If you rent a shop for 15,000 a month, that's recorded here. 5,100. Salaries and wages. Expense compensation paid to employees, whether monthly salaries or daily wages. It's one of the largest expenses in most businesses. 5,200. Utilities. Expense costs for electricity, water, phone lines, and internet. These are regular, recurring business expenses. 5,300. Depreciation expense. This account spreads out the cost of fixed assets over their useful life. For example, if you bought a 60,000 oven with a useful life of 5 years, you'll allocate 12,000 per year as depreciation. 5,400. Supplies expense. Used when office or business supplies like paper, ink, packaging, or cleaning materials are consumed. 5,500. Advertising expense. Covers marketing and promotions, flyers, online ads, social media boosts, and anything to help attract customers. 5,600. Insurance expense. This is where we track the cost of protecting the business, like fire insurance for a store or liability insurance for employees. 5,700. Repairs and maintenance. This includes fixing or servicing equipment, property, or vehicles used in the business. These expense accounts help the business understand where money is going so they can control costs and improve profitability. The chart of accounts is more than just a list. It is the financial backbone of any business. It tells the story of where money comes from, where it goes, what the business owns, what it owes, and how it performs. As a bookkeeper, your role is crucial. You are not just entering data. You are organizing the financial DNA of a company. Each account code you assign, every debit or credit you record, ensures that financial statements make sense, tax filings are accurate, and business owners can sleep at night. Here's what to remember. Know your categories: assets, liabilities, equity, revenue, and expenses. Understand the difference between current and non-current items. Timing matters. Keep the chart of accounts simple but structured. Don't overload it, but don't leave out what matters. Most importantly, always record with clarity, consistently classify, and file with foresight. Whether you're just starting out or managing books for multiple clients, mastering the chart of accounts gives you control, confidence, and credibility. End of Module 2, Lesson 3.